quick moment and thank everybody for attending today's webinar, really discussing the challenges around effectively managing your pension participant pool. And before we dig into this topic, let me introduce my colleague, John Bikes, as well as fellow presenter Michael Krebs with Groom Law. John is the president of PBI Research Services and has been in the death data field for over 20 years, helping found and start legacy.com and then obituary or obitdata.com. John is very familiar with the changing landscape in death data. John leads and provides a strategic direction for PBI. Michael is principal at the Groom Law Group, a law firm in Washington, D.C. that focuses exclusively on retirement and health plans. Michael co-chairs the financial services and fiduciary practice groups, and his practice focuses on helping fiduciaries and service providers comply with ERISA. And I'm Mike Schoenveld. I lead the sales organization at PBI and work with new and existing clients across various market segments, including the corporate union pension space, insurance and financial institutions, as well as government agencies and third-party administrators. I've spent my career working at various large and mid-sized technology companies, specialized in data aggregation and removing the complexities when reviewing data. Just a little bit more background on Groom Law and PBI. Since 1975, Groom Law Group helped solve complicated legal issues for a variety of clients in finance, retirement, healthcare, and the public sector. With over 40 years of experience practicing in Washington, D.C., Groom Law is widely recognized among the nation's leading benefits, health, and retirement law firms. For over 40 years, PBI has been helping pension funds, government agencies, insurance and financial institutions locate missing participants, identifying decedents, locating beneficiaries, as well as cleaning up missing or bad client data, and even addressing issues surrounding uncashed checks. No other provider in our space offers the full suite of services as PBI does. And as a leader in our industry, PBI continues to work with our clients to meet their needs and adjust to the changes from the DOL, PII security concerns, and the increasing complexities in data. PBI has built the largest team of data scientists, product developers, security and IT subject matter experts in our field. And this helps our clients by providing services to save them time, internal resources, as well as providing a defined process, which yields a significant rate of return. For our conversation today, John and Michael will talk through the market changes that they see and challenges, as well as the recent DOL guidance released earlier this year and how that's impacting the industry. During this webinar, again, phones will be muted. However, please send questions through chat and we'll work to answer those questions at the end of this call. Additionally, again, there will be some polling questions throughout the webinar, and we appreciate your participation in that. Let me turn it over now to John Bikes, President of PBI Research Services.
Great, thanks, Mike, and welcome everyone. Thanks for the time. I'm going to talk about two elements of managing pool of people or participants and the associated cybersecurity risk that's come into play. And these two elements you might not think of generally as having cybersecurity risk, but based on some recent changes to the landscape, that they actually pose a pretty significant cybersecurity risk. So the first is, if you have a pool of people, in this case, let's talk about pension plans, and you're trying to determine whether or not someone has passed away. That's a big deal for pension plans, obviously, because you want to not make overpayments, you want to extend the life of the pension plan, etc. It's become much more complex to find out if someone's deceased. And the reason for that really is the graph on the left-hand side, which is intended to show the coverage of the death master file. So the death master file, everyone has a Social Security number essentially. When you pass away, your death gets reported to the Social Security Administration and gets logged in the death master file. So your Social Security number basically gets deactivated so no one else can use it. Up until 2011, the death master file and all the data available in the death master file was essentially available to almost anyone who wanted it for a very low price. So there were thousands and thousands of companies, individuals out there who accessed the death master file, and it was pretty easy to determine if someone was deceased. The death master file had a 95% coverage rate of decedents in the US. It was cheap, and you could locate someone based on one piece of data, Social Security number. So if you have a name and Social Security number, you could identify whether someone was deceased very quickly and very easily. In 2011, laws changed. right? Congress changed the law, and basically states' rights came into play. And most of the data that was being put into the death master file came directly from states. And the law essentially said, hey, that data is owned by the states. They have privacy control. They can decide whether or not they want it to be exposed to people. And all states basically said, we don't want it to be exposed. And so as a result of that, the death master file, as it's known today and is available today, now only covers 23% of deaths. In addition to that, in order to get access to the death master file, you have to jump through a lot of hoops, and it costs a lot of money, right? So basically, before 2011, you had a single source of information to identify if someone was deceased. It was easy to do so. There was a lot of access to death data. After 2011, and fast forward to 2021, now in order to find out if someone's deceased, you need thousands, tens of thousands of sources, in fact. You need not only the death master file, but you need supplemental data, since only 23% of deaths are covered by the death master file. So you need data directly from states. Some of them will sell it to you, not many, but some. And you need obituaries, essentially, right? And there's no single source or repository for obituaries. So you have to go to funeral home websites, you have to go to newspaper websites. It's a very complex task. And there's no single source of or data element that helps you identify a decedent like there used to be. In some cases, if they're in the death master file and you have access to that certain person, 23% of those people, you can identify them with social security number. But in most other cases, you need a lot of information. You need to know name, middle name, maybe if they're a junior or a third. You need to know location. You need to know birth date. You need to know relatives. You need to know all those things, because there's no standard obituary format. Obituaries can contain, a name and a death date, or they can contain a name and someone's life story. So in order to figure out if someone's deceased, you need a lot of PII. And then you need, on the back end, you need matching algorithms, you need artificial intelligence, you need humans looking at this, right? So how does that impact cybersecurity risk? Well, think about, before 2011, you needed a name and you needed a social security number, and the death master file was available to everyone, right? So the death master file was fairly well protected. Most companies that provided this information had decent systems of protection. Hacking in 2011 wasn't really a big deal, right? And so there wasn't a lot of risk back then. Fast forward to 2021. Now, in order to find out if someone's deceased, you not only need to transmit social security information, you need to transmit, place of residence, state, city, birth date, relatives. You need to transmit a lot of information to a provider in order for them to possibly identify a death for you. And then what that provider is typically going to do is they're going to say, here are all the people that I know are deceased because I can match them exactly, typically on a social security number. Here are the people I think who might be deceased, and they're going to send that information back to you or back to the company looking for decedents, right? Think about what this has done. Now, instead of a few people basically looking for deaths, a few companies with limited hacking risk, fairly secure systems, now you've got individual companies, pension plans, life insurance companies, you name it, anyone with a participant pool is now trying to find deaths themselves, because it's not death audit anymore, it's death data. So providers are essentially sending back potential matches. What does that mean? It means all of these thousands of companies have their own systems in place to receive that data. They have people looking at PII, right? We've all heard about shared logins, shared passwords. The cybersecurity risk just went up significantly after 2011, when what you need to find someone who's deceased changed, right? So cybersecurity risk has gone up because you have all these individual companies and systems doing this themselves. And in addition to that, the potential for hacking, as we've seen recently in the news, has gone up substantially. So now the risk from death audit is not just missed deaths, which is a huge issue since 2011. The risk is cybersecurity, right? Getting hacked and having participant PII stolen, basically identity theft, right? Someone gets into a participant pool, steals tens of thousands of records of PII. You can bet that stuff is going to get translated pretty fast on the dark web or sold or done whatever with, and there's going to be a lot of ID theft, right? So huge risk that people don't think about with the change to death audit. People think about missing deaths, but they don't think about this concept of, wow, there's PII floating around everywhere, right? And not only in my company, if I'm submitting it to someone, but in the company I'm sending it to, do they have the right systems in place? What's going on? So what does that mean? How do you overcome this? Well, one thing is, as the DOL guidance recently suggested, there should be standards for any provider that that you're working with, or a pension plan or a life insurance company is working with, if they're trying to find decedents, right? And one of those is, SOC 2 Type 2, right? It's basically technology auditing. It goes through and determines how secure someone's system is, looks at their third-party providers and how secure they are. It's a standard, right? And interestingly enough, in the death audit space, there are several providers out there that are not SOC 2 Type 2 certified, right? And so it's a heads up. If you're looking at making sure that you're limiting cybersecurity, not only eliminating missed deaths, but limiting cybersecurity risk, you really should be looking at what's the security of my third party. Are they SOC 2 Type 2 minimally? Right, minimally, that's what they've got to be. And then on top of that, they should have different things in place. Do they separate databases? Do they hash internally or mask internally data? So if someone broke in randomly, would they be able to tell if they've got my data? Would they be able to see all the participants I have? There are a lot of things that can be done behind the scenes that aren't generally in the DOL guidance that can really protect you, and PBI does those things, right? And so once again, death audit, thought of as, okay, kind of a throwaway thing, but since 2011, big issue with missing deaths, which we'll talk about on the next slide, but even as big an issue now with cybersecurity risk because of all the people that have access or potentially have access to death or to PII. If we want to go to the next slide, I'll just touch really briefly on death audit. So as I mentioned, in 2011, death audit used to cover 95% of deaths. PBI saw that there was an issue with what was happening after 2011 and introduced a product called CertaDeath, which I won't try to sell here, but basically CertaDeath, we handle everything. So you send us PII, we're not sending anything back to you that you have to look at. We're identifying all the deaths and only sending you death matches. You can eliminate all those systems on the back end, so you don't have to worry about people internally working with PII, shared passwords, shared IDs, any of that stuff. PBI basically goes back to the standard of the DMF. If you're not using CertaDeath, you're essentially getting potential deaths. You have to look at stuff internally. If you're looking at stuff internally, we have data that shows the likelihood of you finding deaths. You're finding 60 to 70% of deaths, so you're missing deaths in addition to exposing PII internally. If you're only using the DMF and some state data that's available, you're getting 59% of the deaths. And if you're only using the DMF, as we talked about, you're getting 23% of the deaths. So once again, the summary on this slide is PBI has a product which eliminates missed deaths and also eliminates a significant amount of cybersecurity risk that comes with staff internally having to look up deaths. Okay, why don't we go to the next slide? So the other issue that's come up recently is our guidelines issued by the DOL with regard to finding participants, right, or beneficiaries in pension plans, for example, or even with regard to defined benefit or defined contribution plans. And if you think about it, that's gotten really hard to do over the years. And one of the reasons is the recent issue we've all gone through with the pandemic. So people moving, right, relocating, you don't have to live in the same city you're working anymore. Boy, that's going to really make it complicated to find people's addresses because they're moving all over the place, maybe not necessarily keeping it up to date. So big issue there that's been introduced. A lot harder to contact people. Think about how often you answer a home phone, right? We still have a home phone because our kids are in school and we get a call from the school. But most people don't answer a home phone very often. And it's really hard to locate people or get them to pick up a phone. Aging population, right? More people are getting older in our society, and that means that there's going to be a bigger demand for, pensions or cashing in pensions, bigger demand for 401k. There's just going to be more. There's going to be more demand, right? And so it's harder to find people, and you're going to have more people you have to find. And then you've got the DOL coming in, issuing guidelines and regulations and saying, you've got to do this, you've got to make sure that things are up to date, you can't not know where people are. And so increased regulation is another factor here. So why do I talk about this with regard to cybersecurity? Well, it's become clear that keeping your participant and beneficiary pool up to date, making sure you know where people are, is going to become increasingly important because more people are going to be falling into that pool of people. The government is going to continue to issue more regulations, and it's going to be a lot harder to do. based on some factors that are out there, right? Well, how does that increase cybersecurity risk? In a lot of cases, what we've seen are companies, in order to keep track of beneficiaries or participants, what they've done is they've outsourced things to a call center, to a mail center, right? Think about what's happening there. If you're outsourcing that particular effort to a call center or a mail center, you're transmitting PII to organizations that in many cases are not SOC 2 Type 2 certified, right? They don't have a lot of framework around protecting PII because in a lot of cases, mail houses, call centers, that's not what they're in business to do, right? They're in business to sell or just to send out bulk mailing. And so that's one of the things we've seen come into play here is people really need to start paying attention with the DOL guidelines and with the amount of work required here with the aging population. They need to start paying attention to how they're going about this process of finding people and not transmitting PII, not exposing their participant pool to mail house or call center, not protected systems. And once again, not selling PI or PBI, but we'll mention PBI has products and processes in place which help us find people, keep PII secure, and provide you get a report at the end of the day that says, yeah, we tried to find John Vikas, here's all the things we did. Here's if we found him or if we didn't find him, and I can show that to the DOL or the IRS if they come calling on an audit, right? And everything is secure. So once again, locating participants or beneficiaries typically thought of as maybe a throwaway. DOL guidelines have been issued recently that make it less of a throwaway. Those guidelines will probably become more and more stringent. And so you need a system not only to find people to keep up to date with guidelines, but if you're going to have to find people, to protect your PII.
As John talked about, with all the increased data that's coming at individuals and trying to comb through that, we're curious to know from the audience, what do you find is the biggest challenge when trying to locate our participant? Or it looks like 54% are responding is the last one, that participants don't respond to the outreach.
Yeah, so let me address that really quickly. So one of the things that PBI does, it's really important that even if participants don't respond, that you track and log everything. That's what the DOL is essentially looking for. Or if you get audited by any government, industry, essentially what they're looking for is, did you try to find this person? If you tried to find them, what was the outcome? And can you show that to me? And so what PBI does is we do mailings, we do phone calls, we do social media searches, we'll do certified mailings if that's requested. And more importantly, what we do is we track everything. So once again, I can tell you if we're trying to find someone when the first mailing went out, when the second mailing went out, what the results were. Did we have to call them? Did they answer? Did we find them on social media? If we did, what's that information look like? All that stuff is tracked and logged. And that's really one of the most important things. Not that you just, did a mailing and then got a result. It's really, here are all the things I did. Here was the result. Here you go, Mr. Auditor. I can show you exactly what the outcome is. And that's really what these auditors are looking for. So once again, even if people don't respond, it's really important that you try to reach them in as many ways as possible, but as important that you document that in a way that the auditors can look and say, okay, you did your best to try to find this person, and that's all you can do. So we've already talked about this, but really, in summary, a couple of throwaways in the past, I think, for a lot of people that have been like, yeah, we'll try to find if people are deceased because we want to stop overpayments, but if we find them, we do. For some pension plans, they take it a little more seriously. Really become an issue lately because it's really hard to identify decedents, and overpayments are a huge issue in the pension industry. The size of the stimulus overpayment that we all read about, that happens every year in the pension industry right now because of the way people are trying to track deaths. But more importantly, the cybersecurity exposure, because PI is floating around everywhere. And some vendors or providers just are not set up to handle what's going on with cybersecurity and the recent, advances in hacking, right? And the second thing is finding participants and beneficiaries, making sure your data is up to date. Once again, same thing, become a big deal from a regulation standpoint. Really important to have the right processes in place, not only to find people and document that, but also to make sure that you're working with vendors that have the right security in place, because I think that pension plans in particular, there's as big a risk to cybersecurity and ID theft as there is to any industry, just given the number of defined benefit or contribution people that are in these plans. All right. So with that said, I will turn it over to Michael.
Well, thanks for having me today, and it's great to be with everybody. They always bring in the lawyers to talk about the scary and depressing parts, so I'm going to talk about the emerging body of law around cybersecurity and really just some of the developments in the law and how we're managing the risk. This is an incredibly this area of the law is in flux. It's an exciting area of the law, and it's something that people have to pay attention to, because I think, and I'm not going to bury the lead here, cybersecurity is becoming increasingly important to the regulators, and we're starting to see litigation around this issue. And so it's something people have, I think, been gradually paying more and more attention to, and some recent guidance really emphasize that. So I'm going to start with a little bit of background, just to level set here a bit. As you all know, ERISA is a federal law that governs the retirement plans, pension plans, and the health plans as well that are employer provided. There are state law equivalents to ERISA too. So I'm going to talk about ERISA here, but these concepts would be equally applicable at the state level. And ERISA was designed to protect people's benefits. Congress was mostly worried about mismanagement and theft by employers. And so they created a trust requirement, a requirement that people that handle plan assets have a fidelity bond. So if the money's stolen, they're bonded, there's some way to recoup that. But more importantly, they held people who manage and administer retirement plans out to be fiduciaries, which is the highest standard under the law. And that's true both under federal law and typically under most state and local laws too. The key here, though, from our perspective, is that ERISA says zero about cybersecurity. It's written in 1974, been amended probably every 18 months, ever on average, ever since. But they've never dealt with cybersecurity. Congress has never addressed it, at least not yet. But cybersecurity, and in particular cyber theft, has really emerged as a major threat to retirement plans and pension plans. And the law just hasn't caught up. There's a lot of good work being done, as you all probably know, in the private sector to figure out how to prevent theft and prevent fraud and protect people's data. But for a highly regulated industry, the fact that the regulators hadn't until recently addressed cybersecurity was a bit unusual, particularly because there are some gaps in the legal framework. You know, we look at this a lot, and you will see that it's entirely possible that a plan has been administered prudently. Everyone has met their obligations. The service provider has done what they're supposed to do under the contract. The fiduciaries have done what they're supposed to do. However, money is still missing. And there is a big outstanding question about who's liable when that happens. Is it the participant, the employer, service provider? There's a growing recognition that these are very real questions, and that they're going to have to be worked out over time. And that means we're almost certainly going to see the regulatory burden increase over time. The Department of Labor over the past, let's say, 15 years or so has really shifted its regulatory strategy from being one of guidance on the front end to regulation by enforcement on the back end. And we can already see them starting to set the stage for what are almost certainly some oversight and enforcement actions on cybersecurity. So let's kind of dig into the guidance that we've got, because it's a new development that the Department of Labor has decided to kind of weigh in on these topics and start to give fiduciaries and record keepers and participants some information about what their responsibilities are with respect to data and plan assets. So until about a year ago, the Department of Labor hadn't said much on the issues. people have been asking for guidance for a number of years. We had been in there to talk to them. Another number of other people had, and DOL was just considering its options. And then in May of last year, they issued regulations that made it easier to use electronic communications. They basically created a new safe harbor for the default use of electronic delivery. And as part of that rulemaking, which we don't have to get into here, but as part of that rulemaking, in the preamble to the regulation, in other words, the kind of precatory language that explains what the rulemaking does, they took their first real position on cybersecurity, and they said that fiduciaries must take measures reasonably calculated to protect the confidentiality of personal information. You know, that's just language in the preamble, like I said, and it's not necessarily a law, but it's a big deal. It's the first time the Department of Labor had claimed that one's fiduciary duties extend to the security and privacy of participant information. But that guidance kind of flew under the radar and hung out there until about a year later, in April of this year, when the Department of Labor issued what I consider to be a much clearer statement of its position on cybersecurity. And that came in the form of 3 tips and best practices documents. I'll preface this by saying these aren't law. They are the department's musings. Maybe that's too flippant, but it's their opining informally on policies and practices that fiduciaries and others should take, but they're absolutely not law. The law is still to be determined. It's just the Department of Labor's gloss. But that said, these documents do appear to establish some minimum expectations, at least as far as the Department of Labor is concerned. And the key premise here is that fiduciaries have a duty to mitigate cybersecurity risk. That's explicitly stated. It's kind of the first time the Department of Labor has come out and said that, in as plain as day. And that is very consistent with the position they took in the e-delivery regulation that I just mentioned a second ago. Okay, so let's, if we can go to the next slide, we can talk about each of the pieces of guidance. So the first document is really the one I think for purposes of this discussion today is probably the most important for you all. It's the document that provides tips for hiring service providers. And it's really geared at plan fiduciaries and plan sponsors. And it's broken into 2 distinct components. The first is a component that talks about due diligence tips and best practices. And the second, they talk about contracting and some of the things you should consider as a fiduciary. So on the due diligence side, the Department of Labor says, you know, plan sponsors and fiduciaries, there are things you should ask service providers about with regard to their security standards and their practices and policies and their audit results and things like that. You should really look for a service provider that follows recognized standards for information security and uses an outside auditor to review and validate that cybersecurity. And then they said, you know, that a plan can have much more confidence, and that's a direct quote, much more confidence in the service provider systems and security practices if they're backed by an annual audit report verifying information security systems, data availability, processing integrity, stuff like that. So this was a big deal for the department. They then went on to say, as part of your due diligence process, you should ask how a service provider validates its practices and the levels of security standards that are in place. You should take a look at the provider's track record in the industry. You know, what public information is out there? Have they ever been sued? Things like that. And you should consider whether the provider has experienced past security breaches and how they responded to that. And then finally, they say you should ask about insurance policies. You know, does the provider have insurance policies in the event that they are the victim of a cybersecurity breach when using the plan's data, and how will they make the plan whole? So with those due diligence tips and kind of looking at the background of service providers, the department went on to give some tips around how you contract. And they basically said that fiduciaries should be cautious of provisions that limit providers' responsibility for IT security breaches, and they should review those provisions if they exist carefully. And there they gave 4 big tips in reviewing contracts, and that's to one, talk to the provider about requiring a third-party annual audit, specify the provider's obligations to maintain the confidentiality of private information, talk to or include in the contract the provider's obligation to meet local, federal, and state laws when it comes to confidentiality and PII. And then again, DOL went back and talked about insurance and discussions and contractual provisions related to insurance to protect from cyber theft and other security breaches. So that document, I think, is the one that is the most useful for plan sponsors to the extent that any of these are useful. But they did put out, the department did put out 2 others that I want to make you aware of. The second was a set of cybersecurity best practices. And this was really for record keepers and service providers. And there's a 12-point best practice list. I won't read you the whole thing. You can read that on your own if you're so inclined, but DOL does go on to kind of talk about some of the things record keepers and others should do, using encryption and having access control procedures with respect to confidential information and kind of having all this stuff documented. And this document, these cybersecurity best practices, are really a list of what the Department of Labor might expect to see during a review if they were kind of auditing these providers. And I think they're useful. This document's useful to plan sponsors in that it is something that plan sponsors can ask about. It's a list of the things that record keepers, for example, should consider, and it's helpful for plan sponsors to have that list and be able to ask those questions. As you all know, satisfying your fiduciary duty is and there's a substantive component, but it's largely procedural. And did you engage in a prudent process? Not always did you reach the perfect result. And so if we can ask the right questions and document that process, it's incredibly helpful in shielding ourselves from liability if in litigation and in enforcement actions by a regulator. I will point out that some of this is very sensitive, as you can probably guess. There have been industry efforts for many, many years to try and thread the needle and balance the needs of plan sponsors to understand the security processes in place and the protections in place for PII and other confidential information, balance that need with the need of service providers to keep their processes somewhat secret so that the information doesn't get out to the bad guys, so that you can continue to, so the processes continue to be effective. That balance it's kind of a tightrope to walk, and so there are certainly circumstances where you're going to want information from a service provider, and maybe can't necessarily get it, or they're reluctant to provide it, and there's just going to have to be some compromise on both sides there. The third document that I want to summarize, and I'll do this one pretty quickly, it's a set of online security tips. And this one's for participants. And it basically says to participants that you should really be monitoring your accounts. You should have strong passwords. You should beware of phishing scams, all the kind of cybersecurity tips that people normally get for good IT hygiene. Maybe if that's a term, I'll coin that one here. Good IT hygiene. All the kind of things that participants should do to protect themselves from the risk of loss or the risk of their information leaking out. I talk about this document just to note that I think it is somewhat relevant to plan sponsors and service providers, because it does indicate the Department of Labor recognizes that it's not all on a plan fiduciary to protect the participant data. There is there's some onus on participants to protect their accounts, particularly in defined contribution plans. Okay, so I'm going to get into legislation and litigation here in just a second. Let me give you the key takeaways from these guidance documents. At a high level, they're largely consistent with general industry practice. I think our clients have been roughly following them for a long time, and they're mostly consistent with how service providers have viewed these issues. But they are helpful. They're not unhelpful in kind of understanding your duties, and they do give you kind of a framework for engaging in a prudent process to assess cybersecurity threats and protect plans from them. However, they do also foreshadow some potential future enforcement initiatives from the Department of Labor, and they are almost certainly likely to inform DOL investigations going forward. They don't technically set standards from a legal perspective, but at the same time, it's clearly what the department believes is important from a fiduciary perspective. And so as they investigate people, as they consider whether parties have breached their fiduciary duties, that they will almost certainly look to these documents. And like I mentioned, there is some recognition that participants, at least in defined contribution plans, have some responsibility to protect their data. They have some role to play in this process. Okay, so that's the new cybersecurity guidance. So two other things that I do want to cover in the couple minutes we've got left. One is the litigation that's out there. This is a burgeoning area of litigation. Historically, we have not seen cybersecurity litigation. This is a new thing. However, we have for decades seen litigation against plans and service providers over theft, and so this is really just a new era of that. And we're starting to see in a couple of narrow cases that participants who have suffered losses are making the claim that fiduciaries have breached their duties, by allowing the theft, and I suspect that'll stretch over to the leaking of personally identifiable information at some point. There's one big case out there right now. I think we've gotten a couple of decisions in that big case that have cut the plan sponsor and the service provider's way. These are fairly complex issues, and the big case that's being litigated is one where a participant had an account that was approximately $250,000. It was stolen. The participant sued the plan and the record keeper. The plan sponsor was dismissed from the lawsuit. In 2020, the record keeper recently won a decision. That litigation could still be ongoing, but I think the point here is not the specifics of that case. It's that a participant had their account stolen, they had lost something, and they brought a fiduciary breach claim against basically everybody involved in the plan to try and recover that. And it really highlights that, while that was a theft, presumably a theft, and the authorities are involved, this type of litigation over the breach of people's accounts is likely to continue, particularly as cybersecurity breaches continue. So what do we expect in terms of legislation? Is there anything on the horizon? I'm sure most of you are aware that the states have taken, some states have taken an increasingly aggressive position on the protection of personal information. They're taking it seriously, at least some states, and the state laws are proliferating. At the federal level, there's been a lot of discussion about how federal law should, if it address cybersecurity and the protection of personal data, if at all. There have been discussions about amending ERISA, although those discussions have not progressed very far. I think the Hill is looking at options, including, do we want to require fiduciary insurance for plans that covers cybersecurity breaches? that's still up in the air. In the short term, we're unlikely to see any legislative changes, but maybe in the long term, as we continue to see issues in this space, Congress may feel the need to regulate further. So let me just wrap up and give you the big takeaways here from the final slide. I think there are a few points. One, the Department of Labor guidance is a good articulation of the DOL's views. It may be helpful for ERISA plan fiduciaries, also for public plan fiduciaries to the extent your state and local laws mirror ERISA, but it also foreshadows future enforcement from the Department of Labor. And the litigation is likely to continue. And really, there are some very big unanswered questions there, and a lot of uncertainty. So it's a good time for folks to review their policies, their practices, their procedures, and think about proactively how you would respond if your participant data were breached, if it were leaked to the general public. So I'll turn it back over there, and I look forward to questions on these topics.
Great, thanks, Michael. Thank you, John, as well. So we do have a couple of questions that came through, and Michael, why don't we start with a couple of questions on the topics that you just presented, since that's probably the freshest. Question number one would be is as follows: would you recommend plan service providers to provide a link to the participant guidance? And that follow-up question is, would that help to bolster claims that fiduciary due diligence has been done?
Yeah, so this has been a huge issue, and I really appreciate you asking this one. The Department of Labor put out this document for participants, and there's some helpful stuff in there, and they have no mechanism to get it to participants. I'm going to venture a guess that most participants are not monitoring the Department of Labor website or the trade press. So they probably haven't seen that guidance document. So the question has arisen is, should we be passing that document out? And I think lawyers are kind of all over the place. It does seem to me that it could be helpful in a helpful thing. In the same way most financial institutions pass out scam alerts and phishing alert emails and things like that. This is something the government has kind of blessed as a best practice for participants, and it does seem like it's something at least worth considering distributing to participants. And maybe it's helpful, maybe it's not, but it is kind of hard to see how it could hurt to make it available.
Great, thank you. And let's do one more on that same topic or similar topic. Is what would the potential financial loss for providers for breach of fiduciary duty claims by participants in cybersecurity cases? What would you see that as being?
So there's two categories. I'm going to break it into two separate categories. Category one is where money is stolen. And so let's say I've got a pension or a 401k, and someone comes in, takes a lump sum or drains my account. Now I've got a participant in the plan that is out of benefit, and the plan still owes that benefit. And so there's a financial risk there. That I think to date, most plan sponsors and service providers have dealt with. I think a lot of service providers have covered a lot of those losses. But it's unclear to me whether that can continue in perpetuity, right? There's going to have to be some time when people draw lines, when some of this theft is big enough. And you kind of see that in the case I mentioned where there was a $250,000 account effectively stolen, and now it's resulted in litigation. So clearly the plan sponsor and service providers did not make that person whole for whatever reason. The second and I think more difficult to quantify area of risk is really about the personally identifiable information leaking out. I sometimes argue to my colleagues that if my social security number gets stolen one more time, it's not going to make a shred of difference because it's been stolen so many times at this point. But that said, it is still a real risk, and it is tough to quantify the financial exposure there to plans and fiduciaries and service providers. It's tough to say if you have 20,000 participants, personally identifiable information slip out, what the true loss is to those participants. Clearly, in most of those cases, the plans and service providers make available some sort of credit monitoring, but in the grand scheme of things, those costs aren't they're not massive. The big unknown is what is the actual risk. It is a area where the law has not fully formed yet, and we're still kind of working through it. I tend to take that risk fairly seriously, and if for no other reason that there is a significant non-monetary risk, the headline risk is not great. It's not great to have either the participants that are being record kept, for example, by a service provider, or plan participants. It's not good for those institutions to have who are trusted. They're in a position of trust to these in a trusted relationship with these participants. It's not a great place to be seen as kind of falling down on the job and having, even if you really didn't, and having information stolen.
Great, thanks, Michael. John, let's go back to the discussions and the topics that you went through. There's a lot of data that the questions that we're seeing are managing through all of this data, and the question is as follows: how can the management of the participant pool be streamlined while also recommending various avenues be used for searches?
Yeah, so good question. One that PBI is actually working on. One of the things that we see in our work with pension plans is the use of a number of different service providers, right? Whether it's through a TPA or whether it's directly to the service provider. So you've got companies that might provide a death data or death audit solution. You've got companies that might do your annual funding notice. You've got companies that might do some kind of locate service for you. You've got companies that might do some type of beneficiary research for you. You've got companies that deal with uncashed checks, right? And so when you start to think about the complexity involved with just managing all those processes and putting together, and then you layer on top of that, some of the cybersecurity risks, that Michael touched on, whether it's a true risk monetarily or whether it's a headline risk, man, it starts to feel a little overwhelming, right? And so I'm sure there are a lot of different ways or not, there might not be a lot of different ways because it's not happening right now, but one of the ways PBI has thought about this is, it's going to sound promotional, but it's really the only way I know of right now, is a single solution, right? So you submit your participant pool, PBI does a death audit, we do all the locate services, we find beneficiaries for you, we deal with uncashed checks. It really comes back to is, can you consolidate into a single provider in as many of these services as possible, to limit your risk, but also to limit the management overview, right? And having to deal with all these obligations, which are only going to increase, as we know, with the rules and regulations coming out from the DOL or the IRS. And so, that's one way we've thought about it, is we are providing a single solution, which will be launched this fall. And then on top of that, the only other recommendation I can think of off the top of my head is really just trying to consolidate, these different services into as few a provider as possible, would be the recommendation. So not rocket science, right?
Great, thanks, John. And then this is a question that I'm going to, John, why don't we start with you, but Michael, I'm interested in your feedback on as well, because this is an interesting one. And I'll read the question, and if we need to elaborate, I can, but it really goes to managing through to the DOL guidelines of communicating and trying to locate missing participants. But what happens if you locate them and they still don't respond? So the question is as follows: what's the best way to get recalcitrant participants to respond after you send a certified mail that they've signed for, but they don't respond?
Yeah, so I'll be interested to hear if Michael has a legal perspective on this, but from our perspective, the only thing that we can really do when we're locating participants or beneficiaries is try to use as many means as possible and document that. So we can, we have stats, for example, if you're working with PPI, that show the percentage of people that we can locate via the phone on a first or second phone call, via a letter, via certified mailing, and then via social media, right? So we have stats, and a lot of that, by the way, the results are going to be contingent on the population type, because there are some people a plan hasn't been able to locate for 5 years, and so the likelihood we're going to be able to find them is pretty low, but we'll still try. So I don't have a good answer for, man, how do you find someone who doesn't want to be found or isn't responding, even if they responded one time? The best we can do is go through a process, document that process, and make sure you have it available for any auditors that come in. That's kind of the position we take, is we've tried to do everything we can to find this person. If they're not responding, the next best thing is make sure we're documenting it, so that when auditors do come in, or someone does ask a question about why didn't they get their money, or why don't you know where they are, we can provide the documentation for that.
Yeah, I agree with John. It's tough. I think plan sponsors and service providers have been kind of under assault a bit from the Department of Labor for a bunch of years over this. And some folks didn't have the best missing participants procedures years ago, and there have definitely been improvements. But this is an area of significant exposure, and for better or worse, the Department of Labor's guidance wasn't particularly helpful in clarifying the duties. It was kind of a laundry list of all the stuff you could possibly ever do, and it wasn't kind of the straightforward do X, Y, Z approach that I think folks in the retirement industry were hoping for. That said, we've been experimenting with different ways to find missing participants. There is a percentage of the participant population that is just going to be unresponsive, and no matter what you do, they won't respond. It's not a huge percentage, but it's material. And how you approach an unresponsive or missing participant really depends on the size of the account to some extent. I think there's, for a $10 account, you're not going to spend $1,000 trying to track that person down, but you might for a $10 million account. And so unfortunately, there's not a ton of clarity. I think to John's point, you do the best you can. You take a bunch of as many reasonable steps as possible, and you document it, and you ensure that documentation is there, so you're actually doing something. I think the biggest regulatory and enforcement issues are when the fiduciary has just done nothing. So if you're documenting a process and you're trying, I think that's a huge step.
Great. Why don't we have about 5 minutes left. We have a handful of other questions, and what we'll do is we'll work to respond to those questions offline. But let me see if this is a quick question that, Michael, I'm going to direct it to you, and if John, if you want to add anything additionally to it that PBI might be seeing. But the question is this: should the recent DOL guidance be used as best practice for all ERISA plans? Meaning, should service agreements, BAAs, RFPs be updated to accommodate that language?
Yeah, I think it is, that guidance is what the Department of Labor is looking for. Now, they are not the world's foremost experts on cybersecurity, and so that doesn't mean that everything in there is like I said, it's not law. It doesn't mean it's written on a stone tablet for all eternity. It's just it is. They are helpful tips. And to the extent it makes sense to incorporate some of those or to take those into consideration when negotiating agreements and amending agreements, I think that's helpful. But at the same time, that all has to be done reasonably. There may be a reasonable basis, for example, for liability limitations in contracts if the price is right. And so it's a lot of it's up to fiduciary judgment. I do think the guidance, though, is a very good starting place.
Great, thanks, Michael. Well, with that, why don't we wrap up? Michael, I'd like to thank you from Groom Law and John Bikes from PBI Research Services and everyone that's in attendance today. Really appreciate you taking the last hour to participate in this webinar with us. As with those questions that have not been answered continue to come in, please do so and we'll reach out offline to address those. We did get a number of questions around uncashed checks, around location services for areas outside of the United States, and a handful of other questions that we'll work to address. But with that, I really appreciate everyone's time, and have a great afternoon or morning. Thank you.